following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. My pleasure to be here Monday through Friday, noon, 11 o'clock till noon. And what is today? Today is the 6th of October. And I would say this is getting to be an important moment. A couple of reasons, and let's go through. We'll enumerate them in a moment. I'm showing you the chart here. If anybody's looking at this chart from TFNN, you will see from the Freeman call, that's Freeman from Dallas, who called to find out about having just bought the E-minis, S&P E-minis at 1888. The low was 1883 on the 2nd of October. Wanted to know what would be the parameters. And basically all I said to him was that it wasn't the upside. That'll take care of itself. What'll be important are the downside support levels. Well, that was a spectacular move. He has a 10-minute chart. There's Freeman's call right there. Went up, pulled back. I said this is that pinkish line across there, and that single line, horizontal line. Those are the resistance points. Whoosh! It goes right through the Chapman wave to peak E, then a peak F, pulls back, then it goes to A, B, C, D. Sideways formation. These sideways formations, we're having one right now, are really important because they can last a lot longer than your patience. But as long as the technicals are remaining, at least one of the technicals, especially the MACD, is holding steady, when the stochastic comes back on strong, that can start a brand new up move, which it did. It did that at about 3-something in the morning. Just moving this away. And at 3:30 on the 5th, you started a brand new move that went in this beautiful up channel, ABCDE, pulls back, ABCDEF. I had sent this to the den when we were just about at that level right there, 1997.25, said that we were getting close to the resistance and that I drew in the arch formation that was just near the close yesterday. We actually went about 25 cents higher to 1980.7, 1980 round number high, pulls back in a very gentle channel, down channel. I actually love these down channels because what they say is when you can break the upside resistance, you can go one-to-one to the upside. And basically what it is, it went from 1963.50 to today's high of 1982.25, and that says that's a peak D, and now we're testing that trend line. See, this is a single lines. I have no technicals here. In other words, I don't have 9 EMA, 7 EMA, 200 EMA, MACD, stochastic, relative strength, nothing. No volume, no nothing. No Fibonacci's, no Elliott waves, nothing. Just the Chapman wave notation. And now, I do not want to deceive anyone. I cannot trade it as perfectly as you see the up arrows and the down arrows. This is very difficult right there. Was that going to be an F/B or what is it? And that makes it tough. So I was basically out for quite a while. What you're looking at here is that there are periods where it is just really nice to trade because you've got a trend in place. When you go sideways like this, it's very difficult. But this is the 10-minute chart. What I was anticipating, what I said this morning to my subscribers on my opening call, I always show the E-minis, 120-minute chart and daily. Sometimes I show the weekly as well. I said that peak C should get you to a D. And there's your trend line. Look at that trend line. It does beautiful trend like that. Bam. And it hits the trend line at D at 1982.25. Now the pullback is going to be very important. Why? Dow's up 42 at 16,817. The S&P is down 3.7 at 1953. The comp index is down 31 at 47.49. The VIX is down a tad at 1948. It's under 20, so it's down 0.06. Yep. And what's really important about this is that what we are looking at is a situation where gold has rallied quite strongly. It's up 12 at 11.49, but some of the gold, some, not all, but some of the gold stocks have done fabulously on a percentage basis. So this says to me what I was looking at and talking about in my opening call daily newsletter, this is a different rotation to anything we've seen in years. Why? Because for the first time, well, I've been noticing this for quite a while, but for the first time, off a potential serious low made last week on that Friday reversal, sharply down over 200 and something points, and then closing up 200 points, a 475-point move from low to high. For the first time, we're looking at a situation where you've got sector rotation that is taking in the old cyclicals, like a GE, like a GM, like an Alcoa. This is very unusual, like some of the financials even. And what's really important about it is that what we're getting is a rotation out. This is not into. This is the first time that rallies in the biotech sector, in the healthcare sector, and possibly even in the healthcare insurance type stocks has started to fail. I've been talking about those sectors as being highly vulnerable for some time, and I would not be surprised if this rotation is telling us about the next big move to the upside. However, the very big thing, and I keep getting calls and I get questions about it from subscribers and other TFNN listeners. I've been saying that there should be a higher high to come in the Dow after this correction is completed. I still feel this way, but I could not continue to feel that way if the sector rotation did not occur. In other words, if the cyclicals were pulling back now with and that included the financials, with the biotech, that whole health care area, I'd have to say, you know what? I don't know if there's even room to go up. I don't know what would take us up. As it is, I want to get into some of the fundies, some of the stuff that I talk about my overview with my Trends Watch outlook in a moment. Maybe we'll do that today. I usually wait for Fridays to do that. I didn't get much chance on Friday with all the calls we had, so I'll try to do a little bit of it today. Most importantly, what I'm looking at here is that where the Dow pulls back to today, let me go to this chart here. See, what I said is, this is for my subscribers. This is just one of the, I can't even tell you how much work goes into these daily charts. But what I'd said was, this is where we were yesterday at the close. And what I wrote was at 16,776, the follow-through powerful cup formation should try for the 16,934 level to start leg D up if the technicals remain strong, and I suspect they're going to actually remain strong for the moment. Support is at 16,660s to 16,570s. If there is any hesitancy Tuesday, a smaller doji type candle will be formed like August the 28th, like that candle right there. And so far, we've got a little bit of a hint that maybe we're getting some kind of a doji type candle. That's number one. Number two in this whole aspect is that I had another, a yellow, a warning light to say, regardless of how powerful the Dow futures are and overnight how powerful they might be, there should be some kind of negative action in the Dow today. Who knew that DuPont would after being absolutely miserable for months and months and months, they bounced the CEO, and they're getting someone new, and they're doing a whole bunch of things. So the stock jumps up 3% or something like that. That doesn't change anything. Within a day, you can't get that kind of transition, right? Actually, I'm not even sure it's been made yet, the transition. So that's an aberration. So the Dow's up and the other indices are down. So what is really important about this is I will know within a day or two whether or not we are going to go to this double cup formation as opposed to the usual arch lowercase h to m pattern, and whether or not we're going to break and we'll go to 16,934 to start leg D. If that occurs, you could even see a rally towards 17,290, 17,300 or the 200 period exponential moving average, right? Exponential moving average? Yep, exponential moving average. Changed the color for some reason. Right there. if that happens. So there's a lot of things going on. We've been buyers as well as, so upsetting. We've had a couple of short positions that were just perfect short positions, and they were taken out, and now they are pulling back sharply. What can I say? It happens. It's just the way it is in a volatile market like this. But it doesn't matter because it's telling us, well, it's telling me that we've been right. We've got the right analysis. A couple of percent, a small percentage loss is one thing. But the fact is that we are looking at, we have identified correctly weakness in this market, and we have correctly identified so far the strength. We have not done anything with the gold stocks. Some of them have had fabulous moves. I kept thinking about, should I do it? I just, I didn't want to lose my focus. I know where we're going in terms of what we want. And if I start with the gold stocks, sometimes getting into the gold stock, you can get in, it turns out to be a high, and it suddenly pulls back, takes you out. I decided I would step aside from that. So now let's run a couple of things because this is very important. I'm going to move this away. I'm just going to move it down over here. And I want to show you something. Look at the TLT. The TLT right now is up 26 cents at 123.30. It has made a peak E. That's in the Chapman wave. When you get to a D or an E and you turn down, you want to be looking at the MACD and the stochastic to see whether or not they are pulling back. You want to be looking at longer term or shorter term. Shorter term trend G bounced up against that dashed resistance line. It broke the support level. It's testing now the 200-period exponential moving average in the 120-minute chart. So this is, to me, very important. Why? Because what it's saying, let me go to this. I hope this is going to be able to help. TLT. This is the black background charts with the Dow. With the Chapman wave projections. And in this particular instance, you had tremendous in the 124.40 to 124.98 at 1, 2, 3, 4. Four projections here that said there's a tremendous ceiling to overcome in the TLT, in the daily chart, and the support is way down at 118.32 to 119.63. When you look at the 120-minute chart, it says 121.27 to 122.97 should be support. And where we are right now at 123.06, this is kind of in the middle, right? No, it's above it. And there are the projections for resistance going up to 125.48 and then 120, way up at 127.45. The high was 126.21, right in between. And now we're pulling back. And what it's suggesting to me, if you look at the weekly chart, is that we are just stuck within this trading range. I don't really want to go right now, take this away, to go to that triple yield chart. We looked at it yesterday. So to me, at this particular point, the yields are still stuck in the middle of the range. The actual indexes, the bonds and the TLT are also stuck. We'll be back, and we'll also look at the dollar, and we will look at gold. Basil Chapman, Tiger Traditions out. We'll be right back, up 63.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back. So this is what I want you to look at. This, I decided I would do it. Look, this is the weekly, I showed it yesterday. This is the arch formation that's going to be really important in the 30-year, 10-year, and 5-year yields. All right? Now, I see no reason to even contemplate at this particular point why, with the economic unsteadiness, let's call it unsteadiness, it's not really a word, but unsteadiness, both here and abroad, that would suggest that the Fed does anything to really push rates up higher at this particular point. That's really a key ingredient in what I'm thinking here. The Japanization of bond yields is really not just a 1 month thing. I've been talking about it for well over 10 years, 12 years, I don't know how long, just forever I've been talking about the Japanization of our bond yields, meaning I didn't know when, I didn't know how, I had no clue, I'm not an economist. I just knew that patterns repeat over and over and that Japan did the wrong thing and that we would probably do the wrong thing. I had no clue that at 666 on the S&P that you would start to get a change in scenario where the Fed would start to push money out, low rates, and that's something else completely, okay? But most importantly, what I did think was that something would happen in the economy that would force the Fed to go under the same restrictions as what happened in Japan. There's a really big difference between us and Japan. We have, in fact, gotten a market that went from the 666 level in the S&P to almost fourfold higher. That is Japan did nothing like that. They couldn't get off the bottom for 20 years or something. So this is very different. So while on the one hand there's an exact parallel, we don't know what the result will be. And we don't know, maybe the international markets suddenly come on when we become most vulnerable and they just push rates even lower and lower. I don't know if they can. I mean, where do you go from zero, right? Okay, so I want you to get that out of the way. And then as soon as we're done with our first caller, I'm going to come back and I want to talk a little bit about the real estate market, a little bit of fundies, as well as the technicals. We'll go to Mark in Fort Collins. Mark, how are you? I know Mark's there.
Here you are, Basil.
Hi, how are you doing?
Good, I'm doing great, thank you. I just wanted to thank you for helping guide me through my GDX calls the other day, and it turned out to be quite the trade.
I was thinking of you, and I thought, wow, sometimes we get callers, for instance, when Freeman called the other day at the market, on Friday at the market low, I mean, we get callers that are basically giving unbelievable information to us, the hosts, and let me tell you, it's reciprocal. I thank you, but I didn't trade on that. But the fact is that I think a lot of listeners were listening, and they liked that particular stance that you took. So you got the GDX, and that's doing very well. So you'd like to look at
IBB.
Okay. So,
I was looking right here. It's right where I was looking to maybe taking a quick scalp on the long side at 297-ish. Do you think that's a poor idea for a quick?
Off the top of my head, without even thinking about it, I would absolutely think it's a poor idea. Now, with that out the way, let me do this. Let me do some technical stuff, and I'll explain what I'm looking at. One of the reasons why I didn't go right back into the BIS after trying the BIB for just a very brief moment the other day is because the pullback pre-market of 5 points in the IBB meant that unless I timed it exactly right, if there was any balance at all, I'd suddenly become vulnerable. And believe me, I just, at this point, I'm trying to, I don't want to take unnecessary losses when I know that the trend is going a certain way, and I'll explain what I'm looking at. Because you want to take a quick jab. Now let me pull up both a 10-minute and a 30-minute. Let me get my 30-minute here. 30-minute is right here. 30-minute. So this, I'm sorry, this is what I'm looking at here. For the IBB, and folks, what we're looking at is the 30-minute chart, and what I've shown here is that it made a peak E, and those triple tops right there going into the close yesterday, 1980. It pulls back, it has a quick bounce, it goes slightly higher to 1982.25, and then drops. So now I'm going to switch that, and I'm putting the IBB. And what I will show you is that the MACD and stochastic are still showing heavy selling pressure. Oh, this is going to be interesting. I'd like to talk about it. Do you have time to hold on?
Oh, yeah, I do.
Okay, great. We got Mark in Fort Collins. We'll be right back. Basil Chapman.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks, we're back. Dow's up 34, S&P's down 6. This is going to be very interesting. I'm going to show the IWM as well in a short while. So this is what we've got. So, Mark, this is what I'm looking at. Even in the 10-minute. Now, I took the 30-minute, and what did it do? It went, the IBB, that's the NASDAQ ETF, biotech ETF, went from 285.53 at 14:30. That's at 2:30 yesterday, on the 28th, and ran to peak A, B, C, went sideways, then a D, E, and then an F. And where did the F stop? It stopped at exactly, this is the 30-minute chart. I was asked yesterday by one of our dinners whether or not the Chapman wave works in a 30-minute time frame. And I said, oh, absolutely. So this is the 30-minute IBB, and it went to a peak F with a doji-type top right at the 200-period exponential moving average. Now, this one is one that I had written up for me where I could actually do a scan. I've never used it actually as a scan of what's touching the 200-period moving average. Well, this one hit it exactly right there at 10 o'clock on the 5th. Today's the 6th. Yesterday at 323.59, and it pulled back and made the H pattern that we always talk about, that lowercase h, and now it's gone more than a 1-to-1 to the downside. So now that I'm going to give you a little lecture. And that lecture comes from not just experience, but at times having done 150 or 300 trades in a day. Sometimes itchy fingers can cost you a lot of money. And just to play a trend when the major tide is going the other way, to play the counter trend trade, says if you don't get your timing perfectly, I'm not saying you can't do it. What I'm saying is, if it's just a kind of a restlessness and I'm saying, I'm doing fine on the one side, I'm just going to give it a jab. Those little jabs can cost you most of your profits sometimes. Why? Because those little jabs can make you itchy fingered, and you could get it right, try it again, and then get it wrong, and then say, oh, well, I've got a little profit, I'm going to do it again and again. Boom. The next thing you know, you've given back a chunk of the gains. Itchy fingers, go for a walk, enjoy your scenario, do whatever, go play tennis. But I would not be trading this on the upside. The IBB is highly vulnerable. In fact, it's at a stage now where in the monthly chart and the weekly chart, the daily is so important that if the daily takes out 285, it's only 10 points away. It's at 295. If it takes it out decisively, that whole 284, 285 left side support area, you can see what I've got. I've got a low coming in October to test 284. If you take that low out early, that means that you've got an acceleration down. What it means is that the monthly chart, and this is why the only reason I don't want to keep harping on it, but I have to, for full disclosure, I need to say that we remain short from 393, the iShares. That's just off the 400 all-time high. And I'm looking at, I didn't type it in here. The only candle that's the most important candle in all my work, and I never typed it in. But this Chapman Wave Roman candle, I've spoken about it, but I forgot that maybe I had it and then I took it out. Roman candle right here is so important that if you start to see the IBB trading at, let me just close this out there. If you see it trading at 275, 276, not only have you lost key 285, 284 support, that becomes resistance, and the 325 9-period exponential moving average in the monthly becomes so important, turning down, that there is now, if that occurs, there's going to be very little chance of you getting back to even 325 on a bounce. So I'm looking at this and I'm saying, hey, the trend is down. Itchy fingers can get you in trouble. I see nothing but 3 points maybe on the upside. If this suddenly starts, look, I have to now, the MACD is so close that I'm really close to changing this from a plus to a down arrow. And if this down arrow on the 120-minute chart kicks in, then you could do it today. You could do it today or tomorrow. Just go whoops right down. The IBB is the most vulnerable of all the sectors on the downside for the very first time. And one of the reasons why I didn't want to say to my subscribers, this is a major moment. I think we've made a low and now we're going to test the all-time high, is because when you see a key sector starting to fail and then drag its compatriots down, like the healthcare and the healthcare insurance, what happens is that money has to come out from the mutual funds. What happens is the money comes out, but the guys, they can't just put it right to work somewhere, because usually there's a mixed market going on. Oh, GE looks great, but they know the history of GE. GE has a history of looking great and then plummeting. So they're going to be real nervous. They're going to put that money just for a moment on the sideline, but they'll try to keep extracting money from the fading sector because they know that they want to put it to work later on. So I'm giving you a little bit of a kind of a pep talk here, because I have to do that to myself very often. I'm terrible with the itchy fingers. It's just that's why I love tennis, because I keep moving. I got to keep moving, and I don't like to hang around. And that's the same thing when I'm looking at the stock market. Not that I can't get positions and just hold them for a long time. There's a split personality. I can go for ages, and I can go for 20 seconds. That's the way it is.
Hey,
so
I appreciate that, and that helps me with my itchy fingers. I do have some itchy fingers as well on the IYR, and thinking of going short on that. I just matched kind of a left side, right side time price match.
So let me do this, Mark. I'm going to use you as my kickoff point to go to this chart right here, if you don't mind. This is the chart of Wood, W-O-O-D, the weekly NASDAQ, iShares Global Timber and Forestry ETF. It's gone to a trough F. My suspicion is it's going to be, in fact, I'm going to put it in now. It's an F slash double check F slash B, and it's failed under all the left side support levels. The next level of support would be, let me just drag this across, would be 43.86, and it's trading at 46.49 right now. It's in a nice bounce, and the bounce could maybe go to 47.76. Why am I even talking about it? Because it was the kickoff point when it hit 56.69 back in, I think it was February, March of this year, when it started to fail and make that H pattern that we saw in the GLD index monthly. These patterns are very familiar to us, lower lows and lower highs. And that's it, that the HGX, that the Philadelphia Housing Sector Index, regardless of interest rates, is probably going to become vulnerable, at least in the short to intermediate term. And what we've seen is months later, it turned out to be August, the week of the 21st, at 252.20, it made its not all-time, recovery high. The all-time high is much higher. It was back in 2005. So it made its high at 252.20, and it's pulled back, and it's making lower lows and lower highs. That makes this a really important indicator. Why? Because if the housing sector index starts to trade below the low that was made last week at 214.39, if it starts to trade anywhere in the wait, let me just say that again. 214.39. So if it starts to trade anywhere in the 210 area, then it's highly likely that you're going to test 201, the low of December of this index. And that creates a large arch formation, which gives you time to the downside. So this is going to be very important. Now, I can add another you got a moment? I don't want to hold you up if you've got to go somewhere.
Yeah, I'm just going to throw you on speaker, and I'll let you talk. How's that?
Okay, how about that? So here's the other thing that I had spoken about this. Some of you might recall exactly the moment when across the street from me, a house went for sale. It was in 2000. The HGX index made its high in 2005. Let me go to this chart here so we know we're talking apples to apples. So here we go, HGX index. And if any of you remember, Tom and I were trying our best to short as much as possible the housing sectors, and housing sectors, it was not easy to do. And eventually when it made its high, now let me pull this back, and it made its high in July of 2005. It even did a little retest, and then it started to come down. And what I said to subscribers who have asked me, why do you keep holding the IBB short? Because I remember so well all the different calls I've made over the years where I've called a hat trick top in so many things, and then I didn't hold the short side long enough. I got out very quickly, making a little money, sometimes even losing a little. And I said, no, I will not do that, because I remember well in the housing sector index, when we finally got it right, I took there was one really good 15 to 20% gain we got on the short side in Toll Brothers. But as I recall, but mostly we got out early. And I said, no, don't do that again. And now I'm looking at this peak D in the housing sector index. So now let me go back. So that was 2005. In 2007, August of 2007, the house across the street went for sale. And I looked at it and I said, oh my goodness, this is the exact top. And I remember saying to my wife, I said, if I get a sign and I put it out right now, we'll never get these prices again. I said, we should put that sign out and get out. She said, where will we go? I said, I don't care. So anyway, we didn't do anything. That was the exact top. The guy that bought the house at the exact top sold it for, I believe, it was $300,000 more. He put the sign, did I say, might have mentioned it. He put the sign up in August, again in August. He put the sign up, well, he didn't. He had the broker put the sign up. It was gone before it was even officially open house. They managed to have it open on the Saturday, but Sunday was going to be the open house. It went that weekend. And I said, oh my, get the sign, put it outside. This is the top. Now, I don't know if this is the top of the real estate market. How can anybody really, know for certain? But I know that I was in Brooklyn this weekend, And I know what's going on. I've been looking at real estate there for my newsletter purposes more than as well as many other reasons. And I can tell you, I'm seeing softening for the very first time, and it's subtle. It is only very subtle. There's nothing there that people were saying, oh my God, there's a turn down. I can see the turn down because I know what I'm looking for. But I wanted to bring this up because there's a lot going on here. And therefore, and Manhattan, you must see the skyscrapers going up there. I don't remember seeing that in 2007. I remember seeing some, but what's going on now, mostly in 2007, it was like refurbishing of buildings and a couple of new. Now there are, just state-of-the-art buildings going up. So I'm saying to myself, I know 2017 is what many cycle people are looking at for a major top, whether it's Elliott Wave, a whole bunch of people are looking at different things. I don't know if we can last that long. And if we do, it's going to be the most incredible rally that we've ever seen in history. I don't know about that. So I'm doing a lot of work right now to say, how does this all fit in to a stock like a UTX, United Technologies, which has gone from 124.45 to 85. That is a massive decline. Yes, it's had a massive rally, but for a stock like this is even deeper than the 91.83 to 66.87 30-point pullback in points, that occurred in 2011. Surely it's ready for a decent bounce. Are the cyclicals going to be part of the next move to the upside? So, this is a very, very complex period. I'm trying to make it as simple as possible, but it doesn't always. Sometimes simplicity is not your answer. You really have to look at things a little bit more in a complex way. So, as it stands, the XLF has come back from the 1852 from 2562 to 1852. That's a 7-point decline, a massive percentage decline. And here it is back at 2314. If in the next month, let's call it going into the first week of November, if the XLF is not taking out 22 to 21.25 on any major pullback, but instead is holding quite steadily, then the rotational aspect is really important. That's why I wanted to take the two things that you've just discussed. The IYR, which is the iShares Dow Jones U.S. Real Estate Index. It's the REITs. Mostly it's the commercial properties. But you do have SPG Simon Properties, biggest malls. You also have, I mentioned it yesterday, PSA, which is the in the air. I mentioned PSA is a financial. Isn't that interesting? So now you've got PSA, which is, of course, have I got to look it up again? Yes, I've got to look it up. PSA, I know it so well. It is public storage, doing very, very well. So what I'm looking at here is that there's something going on, and it's really important. And the market has been propped up, and I have to use the word very, not judiciously, very extravagantly. The market was propped up by the Fed in many ways. The dollar is a big factor, and I have to go through this and assess. So now, looking at the PSA, I'm going to looking at the IYR. Gee, can you hold on? You'll be our guest host for the whole hour if you can. All right, good. We've got Mark holding on. I want to talk about the IYR and why it is a little attractive at this time for a bounce. I'll be right back. Basil Chapman, Target Conditions Hour. Dow's only up 1. S&P's down 10.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. So let's just go. We've got the remaining time. We've got Mark online. I said I'd look at the IYR. Oh, man, there are so many questions that came, so many emails and some responses that, I guess it just hit a nerve. Okay, good. Well, that means tomorrow we're going to have a busy program. So listen, folks, let's do this. The IYR is a 73.17. It's made that little potential bounce to the 73.48 high of the 17th, and it's right now the high is 93.51. Of course, I can't even remember what I just said. 93.40. Okay, so it's underneath that. My thinking here is that it could go a little higher, and the 74.17 level is the 200-period exponential moving average. But because the MACD and stochastic are just about to turn up, it says that if there is strength in the market after this day's pullback that I've been talking about here, if by Thursday, if we've gone, not the Dow, but the S&P has gone to a new recovery high, I think the IYR will participate. But I'm looking at it as a potential short. If it's got the mols, if it's got all that stuff that is vulnerable, then I've got to look at it in a little different way. So all I can say is, Mark, if you want to trade it, it's holding very well here. This is different to the IBB. Here I do see a trade, and I see a trade is AB A, B, C, D, E in the Chapman Wave 120-minute chart. If you can get it at 72, between 72.63 and 71.90, and with a 1-point tight stop, I think you've got yourself a potential bounce if the general market continues higher to go to 74.17. And at that point, I would just raise the stop, let it take me out if it starts to pull back. But it is in the area where a bounce is viable. If it actually goes stronger, and in the next 2 weeks, you see it trading at 75, I don't know if it'll do that, but 75.80 to 76.30, that's going to be a good sign. So there's one that I would say, in this trade position, shorter term trading, that's one that I would look at. Hope that helps you.
Yes, it does. Thank you.
Thank you very much. So we got a comment here. I like having Mark as your co-host once in a while. Good. I like it too. So, okay, folks, let's just go through this now very closely. We're going to, you've got Kevin Hinks coming up. Remember, a wonderful, wonderful options show. And then program right through, you've got, after that, you've got Steve Rhodes, you've got Dave White, you've got Tom O'Brien back again, you've got, I think Andy's back, Andy Hecht. So program all the way through. What I'd said is, in the VIX index, let me go back to my daily chart that I show my subscribers. I said there could be a bounce, and that bounce should come here with a little trough E before we go back to test the 19 to 17 area in the VIX, but there should be a bounce. And if this bounce works out, then what we're looking at here is that I believe that we've just got 1678, 98. Oh, I can't do this quick enough. So we're looking at a chance now. Oh, the E-minis made the peak D, but the Dow and the S&P have not gone to the D in the 120-minute chart. So all I'm looking at here is there's a pullback coming. How this pullback takes place, and if in fact we don't have Andy Heck, thank you for Al for telling me. So if we do not have support, well, the DuPont's making a big difference. Let's use the S&P. If the S&P at 1975 cannot hold 1967 to 1963 as key support today, and in fact pulls back even further tomorrow, then all we're looking at is a trading range with a rectangle formation. Look at this rectangle formation that can last a lot longer than your patience. Remember, this is what we're looking at here. And you've got to consider that the counter-trend rallies are going to be ameliorated by the weak sectors. And that's really what you've got to keep in mind. So don't be a hero. Just trade what Larry likes to say, trade what you see. Use whatever techniques you have. I would still be putting in fairly tight stops on longs. And now we're going to look at the rotation. Does gold continue here? And that's going to be very important. So we're about to wrap up. I appreciate you being here. Thank you. Going to have a great show tomorrow. I want to talk a little bit more about my Trends Watch outlook. And there are other aspects that I want to look at as well. We will look at the transportation index, and we will look again to see what bonds are doing. Thanks for being here. Stay tuned for Kevin, and I'll be back tomorrow. Have a wonderful day.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.